Hello and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, March 3rd. I'm recording this from my office in Purchase, New York. It's hard to believe that 2025 is only 2 months old, as shifting winds in Washington have been matched by a reappraisal of the bull market thesis that has persisted since October of 2022. Moving away from the narrative around Fed easing and the Magnificent Seven dominance, markets are beginning to digest the reality of a more cautious Fed and questions around the generative AI theme. To be sure, markets overall have proved resilient, with some strength in sectors like software and financials. However, we observe that markets may now be dealing with potential new headwinds. A recent spat of weak economic data and falling consumer confidence alongside policy uncertainty has caused investors to revisit the growth outlook. So let's consider the data. The Citi U.S. Economic Surprise Index, for instance, has plummeted to its lowest level since last September. Services PMI has fallen into contraction for the first time in over 2 years, with weaker growth in new orders and a decline in business expectations. At the same time, consumer sentiment has weakened, measured by both the University of Michigan Index and the Conference Board survey, as concerns over inflation and the economy have intensified. In other news, January existing home sales have fallen, while the index of leading economic indicators has also resumed its decline. All told, real GDP growth could easily slow in the first quarter from last quarter's reading of 2.3%. Now, none of these data points alone would necessarily mark a departure from our benign soft landing thesis, but complicating matters is the fact that they're happening just as 3 other important variables are showing changing trends. First is inflation. As we have noted, CPI has been anchored at about 3 to 3.3% for the past 7 months, and the recent PCE metrics have shown no real incremental progress. Meanwhile, consumers' outlook on inflation has worsened, with the 5 to 10-year expectation rising to 3.5%, the highest level since 1995. Importantly, combining higher inflation with slowing growth could spell stagflation, typically a scenario that is not good for either stocks or bonds. Second, policy uncertainty is rising rapidly. This dynamic is historically tied to greater volatility, lower consumer confidence, and wider risk premiums. This phenomenon has yet to fully play out, with investment-grade corporate bond spreads at record heights and U.S. equity premiums still negative. Finally, all this is happening while market liquidity enters a seasonally weak period, with this year's tax season likely to be punctuated by headlines about Washington's budget reconciliation process, the new debt ceiling, and the extension of 2017 tax cuts. Promises of fiscal austerity may be potentially beneficial to the long-run debt outlook, but could also create headwinds for short-term growth estimates. Given these dynamics, the current growth scare may persist for a while, and investors are right to be cautious. We do not think the fundamental foundation for earnings, which is the driver of our call for 2025, has changed yet, but risks are rising. With this in mind, investors should consider the importance of maintaining maximum diversification by asset class, by sector, and by geography. In U.S. equities, avoid the cap-weighted index for its equal-weighted counterpart or active management. Consider adding hedge funds for uncorrelated and more stable returns, pairing with investment-grade credit, high-quality munis, real assets like gold and residential real estate, and opportunistic private investments. As always, thanks for listening, and for more information on portfolio strategies and financial planning, as always, please reach out to your Morgan Stanley financial advisor.